One of the risk management measure, one of the classic one is the value at risk, the VAR. And the value at risk is a simple statistical measure used to assess the risk of loss on a specific portfolio of financial assets. And it estimates the maximum potential loss that a portfolio could suffer over a given period of time under normal market condition at a given confidence level. So that's the classic definition. VAR has been one of the most instrumental measures of risk for many, many years. And in the current context of Basel 3.1, and more specifically within the context of FRTB, the Fundamental Review of the Trading Book, within the market risk management components, the VAR is one of those measures which are expected to change, and it's moving from the VAR to the expected shortfall. So, what is the difference between VAR and expected shortfall? It's very similar in essence, right? But the expected shortfall is going to be a more conservative measure than the VAR because it takes into account the average of the tail. And so compared to the VAR, which is at a given confidence level, the expected shortfall takes the average across. So it's going to take into account the more extreme part of the tail. And for me, as a risk manager that trades, I actually welcome that change, even if it means being more conservative, because it's one of those measures which always existed, but which maybe wasn't put on the forefront as much as it is now with FRTB. Still, from a day-to-day risk management perspective, having and still looking at classic VARs on a 99 or 95 percentile level would give you extra information. So, like anything else, it's always good to not only look at one KPI, key indicator, but at several to make sure that you've got an informed decision.